All right, let's jump right in. Today we're going to explore a really fascinating part of behavioral finance, a place where our own psychology creates these predictable, kind of powerful, weird spots in the stock market. It's all about our built-in desire to hit a jackpot.
So let's start with a mystery. Every single time the calendar flips over to a new year, a certain kind of stock just seems to go on an absolute tear. They blow past the rest of the market. The real question is, why? Why does this happen like clockwork, year after year?
And look, the sheer size of this effect is what makes it so wild. You're looking at data that spans decades, from 1964 all the way to 2007. It shows that these so-called lottery-type stocks just shoot for the moon in January. But then, and this is the crazy part, for the rest of the year, they actually underperform. This isn't just some little blip on the radar. It's a huge, repeating pattern. And that's the mystery we're going to solve today.
So, here's our game plan to get to the bottom of this. First, we're going to break down the anomaly itself. Then, we'll dive into the psychology behind why we all seem to love a long shot. After that, we'll look at the hard evidence. And finally, we'll see how you can actually put this theory to the test yourself.
Okay, first things first. Let's get a really clear picture of what's actually happening with these stocks come January.
So, what even is a lottery-type stock? Well, they have a pretty specific profile. They're usually low-priced, they're super volatile, and, this is the key, they have high skewness. Now, what that skewness means is there's a tiny, tiny chance of a massive payoff. You know, just like a lottery ticket. And that's what really sets them apart from your more boring, stable stocks.
We've seen the what, but the why is where this gets really cool. This has nothing to do with your standard asset pricing models. This is all about how our brains are wired. It's about psychology.
The big idea here is something called gambling preference. It's this notion that a lot of us, well, we're totally willing to set aside a chunk of our money for a wild bet. You know, a total long shot. It's funny, the economists Friedman and Savage pointed this out way back in 1948. They saw people buying insurance to avoid disaster, but at the same time buying lottery tickets to chase a dream. It's this deep-seated human hope for that one big, life-changing win.
And this preference, it's not just in the stock market. It shows up everywhere. I mean, think about it. Day trading, buying call options, angel investing, even the whole crypto and NFT craze. They're all powered by the exact same engine, that desire for a tiny shot at a massive, jackpot-style return.
And this urge is seriously powerful. Just look at this number. It's pretty staggering. The lowest income households in the US spend, on average, over $400 a year on lottery tickets. That's 4 times what the highest income groups spend. So this isn't some small quirk. It's a major financial behavior.
This quote, I think, really gets to the heart of it all. For a lot of people, this isn't about calculating expected value. It's about buying hope. It's about having a real, tangible shot, no matter how small, at a completely different life. You're paying for the dream.
Okay, so that's a really compelling psychological story, but is there any hard data to actually back it up in the financial markets? Let's take a look at the evidence.
One of the most important studies on this comes from Alok Kumar in the Journal of Finance. He basically set out to figure out who, exactly, is buying these lottery-style stocks and why. And his findings were pretty incredible. He confirmed that it's individual investors, regular people, not big institutions, who are drawn to these stocks. And get this, demand for them actually goes up during recessions, when people are desperate for a bit of hope. The behavior is also stronger in places where playing the actual lottery is a big deal. But here's the real kicker. Over the long haul, these stocks, on average, are losers. They underperform.
So a follow-up study decided to take this a step further. They asked if maybe really deep-seated cultural things like religious beliefs could actually influence how people invest.
And what they found is fascinating. They saw that in U.S. areas with a higher ratio of Catholics to Protestants, investors showed a stronger taste for these lottery stocks. And even weirder, IPOs in those same areas tended to have bigger first-day price pops. It suggests that these cultural attitudes about risk and gambling can actually leave a measurable footprint on the market.
So, how does this all circle back to January? Well, this chart right here might be the last piece of the puzzle. It shows gaming revenue per visitor in Las Vegas. Just look at that bar for January. It's consistently higher than the average for the rest of the year. It's almost like the turn of the calendar flips a switch. It triggers this collective gambling mentality, this feeling of new year, new me, let's take a shot.
So, we've got a theory, we've got evidence. The next logical question, especially for you, is, so what? Can we actually do anything with this information? How could we test this and maybe even apply it?
Well, based on everything we've seen, a pretty simple trading strategy kind of emerges, right? You'd go long a basket of these lottery-type stocks, and at the same time, you'd short a basket of non-lottery stocks. But the key is you'd only hold that position for the month of January. That data we saw at the beginning suggests this has been a pretty solid strategy over time.
So for your assignment, you're going to test this yourself using a classic event study. Here's how it works. First, you define your event window, say the couple of weeks right around January 1st. Then for each stock, you calculate its daily abnormal return. That's just the stock's return minus the market's return. Add those up and you get what's called the cumulative abnormal return, or CAR. Then you just average that CAR over a bunch of years and calculate its t-statistic. Now a t-stat over 2.0, that's your signal. That's what suggests you found something real, not just random noise.
And these are your targets. You're going to apply that exact method to these 5 big casino and resort stocks. Your mission is to figure out which of these companies, if any of them, gets a statistically significant price bump around the new year. Okay, so let's just recap the big points. We have this powerful behavioral bias, this gambling preference, that makes us want to hit a home run. It seems to get stronger around New Year's, and that creates a predictable surge in these lottery-type stocks. And now you have the tool, the event study, to go out and test this thing for yourselves. Which brings us right to the final question. Before you even run a single number, just based on the theory and the evidence we've talked about, which one of these casino stocks would you bet on to pop at New Year's? Time to go find out.